As I'm recording this, two of the largest banks on the planet have just run out of gold. Not figuratively, not metaphorically, literally sold out. And the question I keep asking myself is whether the rest of the world is about to follow. Welcome to my channel, I am Bogdan Macro, and if you're watching this, it's because you want to understand what's really happening in global markets before the crowd figures it out. If this video helps you see something others are missing, hit subscribe and like, because that's the only way we get this in front of more people who need to hear it. So here's what just happened. According to analyst Alasdair MacLeod, writing on March 6, 2026 for King World News, ICBC and the Agricultural Bank of China have completely run out of investment gold bars. Now let me put that in context for you. ICBC is the largest bank in the world. It has over 200 million customers and over 16,000 branches across China. The Agricultural Bank of China is another one of the country's 4 state-owned megabanks. These are not small regional lenders. These are the institutions that handle the bulk of retail gold sales in China, and they are telling customers there is nothing left to buy. On top of that, the Bank of Communications has reportedly halted gold bar sales altogether. This isn't a glitch, this is a stampede. And it goes further than the banks. According to reports, JD.com, China's largest e-commerce platform, was recently listing plain gold bars at roughly 1,233 yuan per gram. That works out to approximately $5,700 per ounce. Meanwhile, gold on Western spot markets is trading around $5,100. That is a massive premium. And across China, many physical dealers have reportedly stopped offering investment-grade bars entirely, only selling decorative craft bars at even higher markups near 1,400 yuan per gram. Let me translate that for you. Chinese consumers are paying well over $6,000 an ounce for gold products that in normal times would trade close to the international spot price. That kind of premium tells you one thing: demand is overwhelming supply and the system cannot keep up. Now, this didn't come out of nowhere. The People's Bank of China has been buying gold for 15 consecutive months as of January 2026, according to data reported by Bloomberg and confirmed by the World Gold Council. Official holdings now sit at around 2,308 tons, representing 9.6% of total reserve assets, and Chinese gold ETFs saw inflows of 44 billion yuan in January alone, the strongest start to any year on record, pushing total assets under management to a record 333 billion yuan. According to the World Gold Council, Chinese institutional investors who had previously shown limited participation in the gold market are now increasing their allocations. So you have the central bank buying, you have institutions buying, you have retail investors buying, and now the banks are literally running out of product. Separately, the silver market is flashing equally alarming signals. MacLeod noted that silver premiums in Shanghai were running in the 12 to 14% range over London spot prices. On COMEX in New York, registered silver, that is the metal actually available for delivery against futures contracts, has reportedly declined from around 200 million ounces in September 2025 to roughly 89 million ounces. That is a drop of over 55% in about 5.5 months. According to Seeking Alpha, silver is in backwardation, metal is leaving the vaults at a rapid clip, and speculative open interest has collapsed to levels not seen in over 20 years. What that means in plain language is that paper traders have stepped away while physical buyers are draining the system. Now here's where it gets really interesting. Take each of these developments on its own and you might say, okay, that's notable, put them together and they tell you a very specific story. The physical precious metals market, starting in China, is separating from the paper market. The price that gets quoted on your screen is increasingly disconnected from what it actually costs to get real metal into your hands. That divergence is the single most important signal in precious metals right now. And the question everyone watching this should be asking is whether this stays contained to China or spreads to the West. There are reasons to believe it's already spreading. Reports from Bullion Star indicate that London's gold clearing banks, including JP Morgan, HSBC, UBS, and ICBC Standard, have been struggling with physical delivery. The Bank of England's gold vaults reportedly saw delivery delays stretch to 4 to 8 weeks at certain points compared to the usual 2 to 3 days, according to USA Gold. While London officially reports around 279 million ounces in its vaults, only about 36 million ounces are estimated to be part of the available float, the metal that's actually free and clear for market use. The rest is reportedly pledged to central banks, ETFs, or foreign governments. That is a very thin cushion for the world's largest over-the-counter gold market. On the COMEX side, gold open interest is sitting near the lowest level since the COVID pandemic, according to MacLeod's data. Meanwhile, according to JP Morgan's 2026 outlook, central bank gold purchases globally are projected to run between 773 and over 1100 tons this year. That would place 2026 among the strongest years of central bank gold demand since 1971. State Street's monthly gold monitor noted that physical demand globally, especially from China, continues to add price support. The World Gold Council described gold as remaining under-owned as an asset despite being in one of the strongest bull markets in modern history. So what could happen next? I'm not going to sit here and give you a price target because nobody knows with certainty where this goes, but I can lay out the conditions. If Chinese demand continues at this pace, while banks remain unable to source enough physical metal, those premiums will keep widening. If COMEX registered inventories in silver keep declining at the current rate of roughly 20 million ounces a month, the March delivery cycle could face serious stress. If London's float continues to thin out while central banks globally keep accumulating, the availability of physical gold in Western markets could tighten considerably. According to MacLeod, the current geopolitical backdrop, including the conflict involving Iran and disruptions in the Strait of Hormuz, is driving energy prices higher, which feeds into inflation expectations, which in turn is killing any remaining hope of near-term interest rate cuts. That's an environment where demand for hard assets tends to accelerate, not slow down. The broader picture here is that we may be watching a structural shift in how precious metals are priced globally. For decades, London and New York set the price through paper contracts, but as MacLeod put it, with China being more of a physical delivery market, these paper contracts risk declining into irrelevance. Whether you agree with that assessment or not, the data is showing a clear divergence between where paper says the price should be and what real buyers are actually paying for real metal. So here's my question for you in the comments. COMEX registered silver has reportedly gone from 200 million ounces down to 89 million ounces in about 5.5 months. At that pace, when do you think it reaches a critical level that forces a repricing? Give me your date and your reasoning. I read every single comment. If you found value in this, send it to one person who needs to understand what's happening in physical metals right now. They'll thank you for it. Make sure you're subscribed so you don't miss what comes next, because this story is moving fast and it's not slowing down. I'll see you in the next one. Stay sharp. Oh, and before you go, YouTube thinks you might enjoy this video next, so let me know if they're right.